Investor behavior is the dominant explanation of an individual's long-term investment experience. Seems like an awfully strong statement, but let's take a look at two studies through history. Over the last 20 years, ending in 2011, the S&P 500 has appreciated 9.14% compounded year in and year out, with dividends being reinvested. The Dalbar Company has done a study for a number of years, and the numbers remain and the relationship remains fairly constant. What they discovered is that in that same 20-year period, by examining a large number of investor accounts of when the investor bought and sold, that the actual investor experience was 3.27%. Well, that's a dramatic difference. But let's put some numbers to that. Let's say 20 years ago, we put $100,000 in the S&P 500 mutual fund, and we captured a rate of return close to 9.14%. The appreciation of that $100,000, if we put it in the account and then got on a train and looked out the window and never looked to see what the values were, that $100,000 would have appreciated to $575,000. Now let's compare that to the individual experience. That same $100,000 for the same 20 years, the average investor captured an appreciation of $190,000. There's a 64% loss here. There is a loss of opportunity, of potential appreciation of $380,000 in that 20-year period. How else can we explain it other than poor investment decisions? Buying at the wrong time for the wrong reasons and selling at the wrong time for the wrong reasons, oftentimes driven by those emotions of greed and fear. Over the years, I've discovered that financially established investors employ four basic principles. First, they begin with a financial plan. They understand what their objectives are, and they work to implement those objectives. Second, they control their costs, and they identify those costs and work on a regular basis to compress them. Third, their portfolios reflect global diversification. And fourth, they employ a discipline of rebalancing from time to time. Our clients believe what we believe, that an investor, a retired individual moving through retirement, can dramatically improve their experience by employing the principles of other financially established individuals.